Hello everyone, I'm Animesh, your private banker friend. Welcome to the second part of the video blog on the financial world. In the first part of the video blog, I have covered a very important topic, the way the interest rates have been changing and changing pretty fast. I have covered and shown you data how the interest rates have been falling. I have also showed you data about how the bank FD rates, which are currently have fallen to all-time low and currently giving interest in the range of 5 to 6 odd percent. Even the debt mutual funds, be it the liquid funds or the ultra short term or the corporate bonds, are given returns in the range of 3 to 6 odd percent on an annualized basis. We have also tried to show you the data points about how a small change in interest rate might create a much more larger impact on the entire financial asset allocation and the goal planning. So in this second part of this video blog, I think the sole objective is to ensure and to find ways and find a roadmap. How can we consistently be able to make 7 to 9 odd percent returns for the next 8 to 10 odd years? And this is the sole objective and the guiding question that I'll try to unravel in the following PowerPoint slides that you'll be seeing. So what's today's agenda? To brief you out, I think this is the biggest agenda is being summed by this red question mark, which is there on your screen. Find out ways and solutions and asset classes where we can consistently get 7 to 9% return on a consistent basis for the next 8-10 odd years. In doing so, I'll try to identify the debt asset classes which we can look across and which can be looked for the realignment in this portfolio. And in the follow-up exercise, we'll be trying to understand what are the characteristics of these debt asset classes that I'm talking, and how has the underlying funds in their respective categories has been doing. So without much ado, let's start. So the first important principle that I have been mentioned, that we need to identify the assets that needs to do for a realignment in the debt piece. And in doing that, I'll try to first show you the entire basket in the universe of fixed instruments that can fit into the current scheme of things with our late objective, where we intend to find ways to get 7 to 9 odd percent return. So I think in my opinion, there are probably three baskets that can be looked across: the traditional fixed income instruments, which consists of PPF, EPF and the likes. The second basket, I believe, is the fixed instruments which are relatively market linked. When I say market linked, essentially involves the entire categories and the gamut of debt mutual funds which falls into this category. And the third category, which I believe can fulfill this objective, are the fixed instruments which have a mild equity exposure. These equity exposures can range in the tune of between 20 to 20%, 30%, but they are essentially tagged as fixed instruments. So in my understanding and opinion, I think these are the three broader categories that one can look at to get a consistent 7 to 9 odd percent returns for the next almost 8 to 10 years. The traditional fixed income instruments. I think in this particular chart, I have tried to put in only those instruments which will essentially give us 7 odd percent returns. The way to look at this particular entire sheet is that these instruments are specifically for all those individuals who do not want to take any kind of risk and want to have a very surety of the returns that they are looking at from their underlying instrument. So if we can go through the entire thing, I think the first three instruments are pretty common: the Employee Provident Fund, the Public Provident Fund, and Sukanya Samriddhi, which are yielding returns from the range of 8.5 to 7.6 odd percent. I think the second basket, which I have identified by putting an arrow and under these instruments can be looked for all those individuals and investors for topping up their investments, who have exhausted their existing limit in the PPF brackets and want to still park some part of the money for a fixed guaranteed returns without any volatility and want to have a complete peace of mind. So in that scheme of things, there are papers from RBI floating bond which can be looked at, which is given 7.15% returns. Then for senior citizens exclusively, there are a couple of schemes from LIC and in the form of senior citizen deposits, which are given 7.4 odd percent returns. Then there are also further some bank FDs by small finance banks which are still given 7%. I think this could be also looked at. And Then there are further corporate FDs which are floated by the likes of Bajaj Finance and PNB Housing, which are yielding returns in the range of 7 odd percent and thereabouts. Further, there are some corporate bonds and non-convertible debentures and perpetual bank bonds which are still giving a fixed kind of return in the range of 8 odd percent. I'll just like to take a minute and want to explain more on the tax-free bonds. So on the page of it, it might look that these bonds are just giving 4.5 odd percent. But please understand, these 4.5 odd percent are tax-free in the hand. So if you add the tax element, imagine kare ki koi individual which is in the highest tax bracket. So for him, 4.5% tax-free will essentially mean like 7.5% or thereabouts. So I think this is also a very good instrument which will fit into the entire scheme of things. The second basket, which I mentioned in the start, are the fixed income instruments, which are relatively market linked, and I mentioned all the debt mutual funds fall into this category. But I'll not be focusing and talking the entire category of the mutual funds. Rather, I'll keep my effort and energy focused to only 3 baskets or 3 categories of debt mutual fund, जो मेरे opinion में we can achieve the desired objective that have been laid across. So what are those? These are one long duration funds, which are also called as gilt funds. The other category is floating rate fund, and the third category is credit risk. So what are long duration funds? I think the matrix over here might give you some sense and idea about how these funds behave, what are the characteristics. As can be seen, the underlying investment duration of these bond funds are in the range of 8 to 10 odd years. The most important part of these bonds are is that they are essentially carry zero credit risk, which means you will never at any point of time will feel that there is a loss of principal. Also, the very important factor is that on a 10-year basis, the post-tax return is almost better than inflation returns which are there. But a caveat इसमें जरूर है कि in the shorter run, for 2 to 3 odd years, इस तरह के schemes or categories of mutual fund में you will see a relatively higher volatility. So what I've done over here, and by no imagination, please understand these are not investment recommendations. I've just pulled up data of the particular schemes which falls into these categories. I'm trying to throw numbers and want to prove how these funds fits into the scheme of things. So what I've done, I've just pulled into schemes which have been floated by IDFC Government Securities, and the other is SBI Magnum Constant Maturity Fund. So if you can look across, there are 3 columns: the trailing returns, the roll-in returns or the average returns, and the probability factor that throws in the last column. So I think trailing return is a number that it changes. The point-to-point return, I think one should not look at because it can be anything. But I think the most important factor is the average return of the rolling 10-year return. So आप अगर rolling 10-year returns देखें दोनों funds का, it has been in excess of 9.5% for the last 10 years. And the last column, the probability जो हमें दिखा रही है, so both these funds has almost 100% probability of giving 8 to 12% returns if one stays invested for 10 years. I think this is the most important thing, 100% probability. No one gives you this kind of 100% probability, but these funds have shown that 100% probability one can make a return in the range of between 8 to 12% if one stays in for 10 years. I think that is the reason I have just put this particular paper as the first category under this fixed income instruments. Floating rate mutual funds. So what are floating rate? I think floating rate mutual funds are essentially papers which one can look at when there is a reversal or proposed reversal in the interest rate scenario. The average modified duration again over here are pretty low, between 1 to 2 odd years, and these papers have the exposure to the highest rated corporate bonds, which means that you will not lose principal. Compared to long duration or gilt funds, these papers have relatively much lower volatility. Performances of the underlying schemes, and as you can see, there are a couple of papers from Nippon and HDFC floating rate fund, and I'm plotting the data of the 10-year returns, how these papers have performed. If you see, the average return for the last 10 years has been again in excess of 8% consistently. Both these papers have almost touched 8.5% return, and again the probability factor of delivering this return between 8 to 12% is again 100%. So I think these two papers are fantastic categories to look across. Someone is looking at a lower volatility and does not want to have a exposure of risk. I think floating rate funds does suits the bill. आप आराम से इस कैटेगरी में डाल सकते हैं. 10-year period, I think both these papers are champions, which most of everyone should have in their portfolio. Credit risk fund. I think we in the last year and a half there has lot been spoken about the credit risk fund. We have seen one of the top AMCs, Franklin, for that matter. People have got their money stuck in this category. But please try and understand every category of papers. There is a need for it, and the investors need to identify what are the basic characteristics and does that suit their requirement. So if I have to give you a gist, the credit risk funds again has relatively on a lower modified duration, or the investment duration the papers holding are between 1 to 3 odd years. There is a considerable credit risk, and which means that you might also lose principal in the shorter run, and there is also a liquidity risk which we have seen in the Franklin episode where money is being still stuck in. However, these are being compensated by relatively higher portfolio returns which one can look in the shorter duration. So in this category, this category is still evolving, and 10-year data is still not very much available in public domain. So I have stick to the 5-year data point, which is still a good reference point to look at. So both these underlying papers which are being floated by HDFC credit risk and ICICI credit risk on a 5-year average return have delivered like 8% in excess of returns, 8.25 and 8.30 to be precise. The probability, if one look at a standalone number, is in excess of 80 odd percent. In SDFC it is 83%, in ICICI it is 96% that they, for a 10-year period, ये दोनों fund will deliver between 8 to 12 odd percent, and that's a very good probability to work with. But when you want a comparison with the other categories, I think one will always want to go for a 100% probability if there is a choice rather than going for a lower probability. So I think things should be looked into that perspective. National pension scheme. I think national pension scheme, most of the people would be knowing because of the fact that it gives you an income tax exemption under ATC, and there is a 50,000 additional exemption, and people are putting their money just to take a tax exemption. But apart from the tax exemption benefits that this particular product brings on the table, it also has the other benefits. As you can see under the matrix, I think this paper has again a very high exposure to the best quality papers that are there. The average investment duration or the holding period of these papers are between 3 to 4 odd years, and generally the tenure of these holding is on a higher side. So for pure understanding sake, what I have done is that I have picked in SBI as the fund manager who have been managing the funds in NPS, and I have picked up the schemes which have been managed by SBI. So I picked up a scheme C, which is a corporate bond, and scheme G, which is a government bond. So if you can look onto that data, I think it just throws you an exciting and interesting number. For a 7-year period or for a 10-year period, both these schemes in corporate and government bond has been able to deliver almost double-digit return in the form of 10% and beyond. So one should surely look across NPS, and even this numbers corresponds and collaborates the fact that if one is looking at additional allocation apart from that NPS allocation, the standalone long duration bonds or floater rate funds can be looked at alternatively to augment the return. So the third basket is the fixed income instrument which has a small equity exposure. So in this particular category, there are 3 underlying schemes one can look at. One is a conservative hybrid fund, the other is an equity savings fund, and the third is dynamic asset allocation fund. And it's in conservative in nature. Under this category, there is a small allocation of equity which is in the range of 20 to 30% which has been done, and the debt allocation has a modified duration of between 1.5 to 3 odd years, and essentially this category is suitable for people who are into the conservative risk appetite and are pretty okay of having an exposure of around 20 odd percent, and which also means that there will be relatively higher volatility compared to the debt mutual funds. So following the template that I've been doing, I think I've just pulled in the number of underlying schemes. If you can see, the quoted debt hybrid and Canara conservative hybrid falls under this category. The average or rolling 10-year returns of both these funds has been in excess of 9 odd percent, which is 9.54 and 9.06. The probability factor is again 100% of delivering a returns between 8 to 12% over a 10-year period. I think this number just takes everything out of the picture, every doubt of the picture. One should surely have these kind of papers in their portfolio because it very much ensures that you make around between 8 to 9 odd percent for the next 10 odd years. Equity saving mutual funds. Equity saving mutual funds is a category which has just evolved over the last 4-5 odd years. Under these categories of mutual funds, the underlying paper have an equity allocation of almost 65%. When I say 65%, it does not mean the entire allocation is 65 into naked equity. इसमें करीब 40 से 50% is into arbitrage positions and the only 20-30% goes into the equity allocations. Balance around 20-30% are invested into the debt papers, which relatively has a modified duration of between 2 to 3 odd years. Again, it is suitable for people who falls into the conservative to moderate investors. And the value that this category brings is that since it has an equity taxation. So debt taxation is not applicable. Every gains, long term or short term, are subjected equity capital gains tax. Under these categories, if you can see, if you can have a look, both these papers from ICICI and Kotak Equity on a 5-year rolling returns has given 7.4 odd percent and thereabout returns. However, the probability is relatively lower. Somewhere around 30 odd percent is the probability for these funds to deliver returns in the range of 8 to 12 odd percent. So I do understand it has a lower probability, but try and understand that even on a 7% kind of CAGR returns, 7.5% CAGR returns, considering the fact that equity taxation is applicable over here, one can look at making almost 7% post-tax, and that is something that one needs to be aware of and accordingly identify if it fits into the scheme of things. The equity taxation brings a lot of value to this particular category of papers. Dynamic asset allocation. I think of late there has been a lot of talk across of this particular category. And essentially, the reason these papers are into the scheme of things is because it has the objective where you can raise the equity allocation from 40 to 100% at any point of time. Because of a higher equity exposure suitable for people who are generally into the moderate risk appetite. It also has an equity taxation. So we have seen how a small bit of equity, if one adds to the portfolio, it just takes up the entire returns on the overall portfolio, and that's what a small allocation of equity does to the entire fixed income instruments. The same is happening over here also. If you see, both these balance funds has been consistently delivering returns on an average basis for the last 5 years, almost 12 to 13 odd percent. However, the probability is generally on the lower side. It is around 38 to 40%. But imagine from the context that even if there's a probability of making 40%, 40% probability of making returns in the range of 12% and beyond, I think that's a good probability to work across. It just takes up the entire portfolio returns from 7 to 9% to almost 12-15%. That's a jump of 4 to 5% over a pure plain vanilla fixed income instruments. But the caveat is that these kind of funds are relatively higher on the volatility factor. So one needs to be aware of their risk appetite and take the call accordingly. So we have discussed in complete details how the existing fixed instruments are and going forward will deliver returns in the range of 4 to 6 odd percent. So that was the entire genesis of this entire presentation. So my endeavor was to identify and assets and underlying categories where one can realign their portfolio and can get almost 7 to 9 odd percent returns. So entire allocations that I did propose was a roadmap in that particular direction. I do hope these kind of informations that I've intended to provide you out might be of some use to you and you can get some insights. Managing your money is your responsibility. No one gives a damn care how you are going to do about it. My objective is just to help you guys travel this journey in a much more pleasant manner. And if you like this particular video, do give us a thumbs up, like, share and subscribe that so that it reaches to a much more mass audience. And stay safe in these COVID times and be healthy. Thank you.